How we doing, y'all? Everyone hanging in there? It's great to be back in the beautiful state of Tennessee, in the greatest city in the country, Nashville. Local here, and really appreciate everything that Rod and the team have done. Bitcoin Park is a special place, and just to echo what Rob was saying on that last panel, I've been to a few NIMs now, and the quality of content is great, and this one is no exception. Might be the best yet. So hope everyone's having a good time. We'll be talking about financialization of energy assets and the hash rate. And just a quick intro from all of us. My name is Colin Harper, editor-in-chief at Blockspace Media. We cover data centers, energy, Bitcoin mining, AI, Bitcoin, podcasts, written content. You can check us out at blockspace.media. But I will hand it over to you, gentlemen, for some quick intros as well.
Thank you, Jeremy Ellis. I am filling in for Dan of OBM. So I know a lot of you that bought tickets are probably looking for refunds. That Dan's not here right now. So unfortunately, he was able to make it, but I am director of power strategies at OBM, also more commonly known as Foreman. And so I work with all of our end-use software customers, partnerships with all of our energy suppliers, Queasy, CSPs, anything kind of energy related and how it relates to our software, and so they can maximize and optimize their energy load.
Hi, I'm Rory Murray. I'm the Vice President of Digital Asset Management at CleanSpark, where I focus on our Bitcoin Treasury HODL. We look at ways to fund the business, generate yield off of our HODL, enhance our cash management, and just anything that kind of touches Bitcoin at the Treasury level sits in our group.
Rory is also chief literary officer at CleanSpark. He'll get cosmic on Faulkner, Hemingway, and
As I lay hodling says that. Yeah, thank you.
All right, so just to kick this off, we'll start with a little light question. As Bitcoin miners, what is the number one thing that keeps y'all up at night, and how do you try to manage or hedge that risk? Rory, maybe we'll start with you and then go to you, Jeremy.
Yeah, it's that the amount of Bitcoin you mine goes down mechanically every 4 years, and so I think that's a real pickle, if as a Bitcoin miner, and I think that's exactly what we're trying to get ahead of with this digital asset management group, is the idea that as the markets mature and evolve, you bring that Bitcoin, out of the ground, and you mine it and you put it into circulation. Now you have a real, sovereign reserve asset that can back credit products, that can serve as a payment mechanism, that can serve as a store of value. And so how do we go from kind of, we're always going to be focused on the mining. We believe that that's going to be a very sustainable business for a very long time, particularly for those that have scaled, scaled access to globally competitive power prices and world-class operations. But how do you then kind of continue to find ways to utilize, benefit, and continue to drive, more adoption of Bitcoin on the capital market side?
From my perspective, it's pretty easy. It's cost of power and available power. I think as you start to look at, with AI and all this other load that's coming online, the Bitcoin mining space is increasingly looking for access to power. So we're seeing, more mines coming into non-traditional markets, whether it be overseas, South America, some of the states that, we've seen kind of come online and really take precedence, Wyoming, Arkansas, all these utilities that are becoming more favorable. And then obviously with the price of power, how you can leverage it, where you can use your flexibility to decrease that price of power. So those are really the two big factors, and how you strategize around that is really the things that we're trying to help customers with. But every time we're having conversations, it's always really directly power related, and how that's going to be against their bottom line.
Man, y'all making my job easy, because you basically just gave two sides of the equation for what are the most important things for miners to think about in terms of their input costs, and then what the output for that will be. So that leads really well into my next question, just to kind of set the stage for those who might not be as familiar with this topic. I assume a lot of people in here are, but can you give us a quick rundown of all of the different variables, or rather the most crucial variables that miners have to think about in terms of hedging their risks, and also what tools are available to help hedge those risks? We'll start with you, Jeremy, and then move to you, Rory.
Yeah, so when you're talking about risk, obviously a lot of that is tied to the price of power. So really it just starts with where you're going to be located and how fast you're going to get access to power. So down in ERCOT, you're waiting for, you're in a queue. Obviously there's, CapEx costs, things like that, site development. And if you're, waiting for a long period of time to get your operation up and running, how much money is sitting on the shelf there. Once you determine where you're going to be located, now it's how do you kind of negotiate whatever your power contract is. If you're in a deregulated market, you're talking to your retail suppliers, you're talking to your consultants and brokers and things like that. Getting the best contract that really leverages your flexibility and how you can use your load. From that point on, it's really the cost of power and how much perhaps collateral is being asked of you to in order to get that power. So, we've had a product that we've introduced, the real-time settlements, that's trying to reduce that AR risk on the supplier side, but also take some of that collateral off the table for the miner. Obviously, cash is king. So if you got that cash available so that you can use it for hardware upgrades, site deployments, all those type of things, we're trying to help put that cash back into your pocket. And then, once you start to, get up and running, selecting a Queasy, selecting a CSP, managing your demand response programs, how they work in concert with your supply agreements, make sure that they can work together and they're not cannibalizing one another and you're not being non-compliant towards your demand response obligations. So really those are the things that, you got to check all those boxes as you start to kind of get set up. If you're in a regulated area, what's that tariff look like? Is there some advantages for you to be flexible? Is there a demand response program? Is there a 4CP or a demand mitigation component where it might be a 12CP, and how easy is it for you to kind of benchmark and use that flexibility? So really, you're trying to, optimize that flexibility to really take advantage of the financial benefits for you, and then how fast you can actually get up and running in your speed to power.
Yeah, I mean, awesome answer. I think it does seem like this is kind of turned into an interesting panel just because I'm really, my background was at Grid. I've been steeped in the Bitcoin mining space for some time now, but really what I do every day now is really focused on kind of the financial markets. And, we talk about going from Spark to SAT, right? And eventually sometimes you even got to go to dirty fiat because you eventually got to pay, your bills in dirty depreciating USD. And so to me, I see kind of three different bottlenecks where you're really subject to market forces in the Bitcoin mining space. There's obviously the cost of power. There's that side. There's tools that you can use to hedge, but I was just reading this great Twitter thread where all great kind of literature is residing these days in whatever this era is. But it's talking about how and I think it was maybe a wind power site, and that they had just mismatched their hedges, right? And so you hedge your generation, and they were talking about batteries with this upcoming storm. And so essentially, if you've sold these power hedges and you expect that the sun, maybe you haven't oversold it, but the sun's going to shine for somewhere between 4 to 10 hours a day, and then it goes to zero for 3 days, you're really kind of upside down on that. So there's that side of things which I'm not as familiar with, and it sounds like you are much more, and I'd love to learn from you. I think on the one that we all understand is the difficulty adjustment. So that's something that we really don't have. We really don't have much control over directly. You can't even operationalize around it, right? You can talk about risks in a business and how can you be best in class, how can you train, how can you kind of continue to find efficiencies, but you really don't have control over what everybody else is doing on the difficulty side. And then the last side is the price of Bitcoin. And so I think it puts it, and I think that the last kind of era of Bitcoin and Bitcoin mining was really about, these were really kind of critical risks. And I think that we were really criticized as an industry, and sometimes rightly and sometimes wrongly, but I think it was just a maturation phase. And to me, what I'm sitting at is I'm seeing three really critical areas where you can monetize, where you can hedge, where you can add value and you can add margin. So, to me, it comes down to cost of power, difficulty adjustment, and the price of Bitcoin. And if you can figure out, and we haven't yet, but this is something that I think about a lot, and that Lisa Huff, sitting in the audience, was pressing me on back in September, and I still don't have any good answers for. But if you can marry those three things together, I think you have a potentially very interesting looking kind of institution.
You say marry those three together, you mean having some sort of platform or some sort of some sort of option where you can hedge all of those all in one place? Is that
I don't know if you'd hedge them all in one place, but I think what you want to do is you want to start to isolate variables, right? If you can isolate your power price and you know it's going to stay within a certain band, then you know you can pretty much forecast what your uptime is going to be. If you can forecast what your uptime is going to be, you can you can kind of have a sense of what's going on in the ASIC market. If you can get a sense of that from a business intelligence perspective, you can have an idea of kind of what's going to come online from a hash perspective. If you can get an idea of what's going to come online from a hash perspective, you can get an idea of how much Bitcoin is going to hit the balance sheet. And then, I don't know, God bless you with the market price. But what we do with the market price, and I think we'll get into that, is that we're trying to monetize that volatility as well. And I think of it as kind of is kind of the third wheel of all of that. Does that make sense? When I'm kind of no idea.
well, going back to the trifecta of pain points to hedge for, I mean, you can kind of turn the triangle on either side, but the way I see it is like the base is Bitcoin price, your energy price. Those two things, I mean, I'm not going to say they're solved problems to hedge, but there are plenty of tools available in terms of how you're going to structure your power purchasing agreement, in terms of some of the derivatives available for Bitcoin. The third one, the peak of the triangle, is hedging actual hash rate and difficulty, or hedging difficulty specifically. There have been a number of products that come to market. I mean, the one that comes to mind for me first, because I used to work there at Luxor, are the hash rate derivatives. I'm curious, Roy.
Shout out Matt Williams.
Yeah, shout out Matt Williams. Speaking of, he's going to get back to Ethan and Nick there soon. Well, on that note, I'll throw this to you first, Rory, and then Jeremy would love your thoughts on this as well. How has that ecosystem in terms of hash rate derivatives evolved since that product has launched and since other products have launched? And just kind of like speaking frankly, Rory, like what about that product makes sense for you as a miner, and what about it doesn't necessarily make sense?
Yeah. What I've seen is that it seems to me like there's only two real providers who have been able to stand up a sustainable kind of hash rate product. And from what I have seen and understand, and I don't know if this is, I don't want to, get something incorrect, but it seems like that's been really difficult. We get pitches all the time, and I've been getting pitches for years about these different products and hash rate products. And it seems sort of like obvious that that's what you would want to do. Now, I think that what's incredible about what Luxor has done and what Matt's done with his background from the CME is he really understands at a contract level and at a participant level, kind of what you need to do with the contract side and the different types of participants you need to get in order to create that platform in that market. So we have a relationship with Luxor on that. We have not really been that active in that market. It's something that I'm very interested in expanding into. I think from a hedging perspective, it's again a little bit tough because you really have, again, that kind of one-sided demand. Either everybody's kind of like really trying to make up for lost time, or they're really trying on the downside, or they're really trying to make up for lost time on getting kind of exposure on the upside. What I think is particularly interesting about what they've done is you can essentially marry this deliverable forward with this non-deliverable forward. If you do that, you can decompose that into essentially a Bitcoin denominated interest rate.
Yeah, can you unpack what you mean when you say deliverable versus non-deliverable?
Yeah, so when you sell a deliverable forward, what you do is, let's say I'm selling a deliverable forward for hash rate, and I'm doing it on 10 exahash, right? And that means that you can basically get the price of 10 exahash over 30 days today. And you say, okay, for every 10 exahash, I expect to receive, we're gonna use round numbers, 1 Bitcoin a day for 30 days. So I know that if I just put right out as of today, I point 10 exahash at the 256 Foundation telehash address, and they're going to get 30 Bitcoin that we expect over 30 days. Now that's going to change because difficulty is going to go up and down. Now, what you can do is you can sell that today for 28 Bitcoin. And so you receive 28 Bitcoin, give it right to Rod, right? And then and they kind of continue to work on the ecosystem there. But what you can do is you can pull that capital forward. What you can do on the other side is you can then buy the non-deliverable forward. And what that does is essentially I owe the hash rate over that period of time, and the price of that is going to change denominated in Bitcoin. And if I also buy the NDF against it, what you do is you've now neutralized the price risk inherent in that. And so what you end up with is what looks like a USD denominated interest rate using Bitcoin, or a Bitcoin denominated interest rate. So I'm still thinking about this a lot, to be honest with you. This is like probably the 20th time that I've thought about this. I think I'm still getting parts of it wrong, but I think it's really interesting because I'm still thinking about kind of Bitcoin denominated interest rate. So that's where I think it's most interesting, but you haven't seen a ton of take up. And the only people that I've seen really be able to kind of get over the hump on the liquidity side is Luxor.
Anything to add to that, Jeremy?
Not so much. I was hoping to avoid that question. I have had conversations. Shout out Jeremy in the back from Luxor. We've had a couple conversations about it. I've talked to Matt about it since we're both out of Chicago, but that's something that I'm still kind of getting a whole grasp on. But very interested in it just because how it adds some optionality to the whole space, and another financial instrument that you can kind of stack onto everything.
But isn't it fascinating? Like, it is the most mental primitive input to Bitcoin mining is that difficulty adjustment. And yet the financial products around it just have not really fit the risk profiles. I don't have a great answer for that, of why that is. I think part of it is just kind of the boom bust nature of kind of the volatility of the cycle, that people want upside or they want downside. I think part of it is just kind of a mismatch between counterparties. You know, these miners who are very, very long hash rate, they probably want to be selling that at the time when the hedge funds financial.
You have to have someone on the other side.
You have to have somebody on the other side. And so it's really a two-way marketplace right now that's very much about matching buyers and sellers, and not about kind of having a standardized contract or something that is listed on an exchange that can price daily. So once you're in it, you're kind of stuck in it. You're stuck in it for whatever period of time. You know, you're facing, you know, Luxor's done a good job of kind of making sure that you're facing them rather than direct other counterparty. But let's be honest, if it's just you and them in the market and Luxor's in the middle, and this is not picking on Luxor, this is not picking on any kind of intermediary in particular, but that credit risk is on the other side. So I just think that this is chicken and egg problem, until you get a standardization of contracts, which is what the CME solved back in the 70s and 80s, and you get really kind of a lot more of a depth to that marketplace, I think it's going to be hard.
I mean, you can imagine like walking into Wall Street and trying to have a conversation similar to the ones that they had when they started spinning up derivatives for agricultural products, right? Like the reason why
that was the whole point. I mean, that's how it started, right?
That's why it's also in Chicago. It's because like the market for that, you're looking at the Midwest, you're looking at a lot of the grain and soybean and corn producing parts of the U.S., and farmers needed a way to hedge their risk. It's a lot easier to go to them and explain why these products are necessary and how the banks can make money taking the other side of that. Then you go in trying to talk to them about Bitcoin contracts and hash rate and difficulty, and you look like a mad scientist or some crazy person. So hang on, so there's this thing that happens every 2 weeks, and like, oh wait, and hang on, the actual commodity, the production gets cut in half programmatically every 4 years, and
who invented it? We don't know.
We don't know. And then hang on, then there's a transaction fee piece where it's like sometimes transaction fees are sky high, and then like right now, anyone who mines knows that they're absolutely dead dirt in the water. I mean, you can put through a transaction for sub 1 cent or sub 1 sat per VByte.
Don't remind me.
We'll move on to the next question. One last thing I wanted to say, when Rory says they haven't looked into Luxor's products very much, that's actually a subtle flex. He's saying that CleanSpark's operating costs are so low that they don't have to worry about it right now. You don't have to say anything about that, Rory.
We have a relationship with them. Like, I've signed an ISDA. I used PandaDoc, okay, which I have no idea why you guys use PandaDoc, but I use PandaDoc. I always give Matt a hard time about that. Again, it's just that I think that the locus of what you have control on, and the locus of products that have been developed, and that you can really match off your assets and liabilities from a geographical perspective, from from a price perspective, from a time perspective, are developed in the energy markets and in the financial markets, and they have not been developed in the hash rate markets yet. Thank you, Lisa. I knew you would appreciate the energy hedging side, but so I think that's kind of the problem.
Jeremy, to throw one at you really quickly, looking at miner management software, I think about when the great hash rate migration happened after China banned it in 2021. And the play then, if you had hash rate online, if you want to rip those suckers 24/7, you are not thinking twice about how long they're going for, or because hash price was just absolutely sky high. I think it hit like $420 per petahash per day at the peak in 2021. It's a little bit different now. Margins are not as they're not the thinnest they've ever been if you have new gen equipment, but they're pretty thin. Hash prices hovering around $40 per petahash per day. How have you seen miner management change since the 2024 halving?
Yeah, that's a good question. When I first got introduced to the Bitcoin space, I was working in energy management at a company called Sea Power, selling demand response, and typically going out to CNI customers. And you might be at a 10 megawatt customer, and you're trying to extract 500 kW to a megawatt of curtailable load, and figure out how you can do that and engineer around it. The Bitcoin space presented this new, just great frontier of, hey, I've got 5 megawatts, I can curtail 5 megawatts. And so when the first event that I actually went to your point, I went out and I explained what I did and where I was coming from, and it was met with, "We're Bitcoin miners. We don't shut down. We're going to be running 24/7, ripping Bitcoin and hashing." So, obviously that's changed. The miner management space is, it was always just kind of a dashboard and a look to the health of the mine. When I came on and I met Dan and the team at OBM, it was about, hey, how do we optimize and really start to automate the curtailment side of it to really leverage the flexibility of these mines. So the power controls became a big side of it. Now, the one thing that we've really started to attach to all of our customers is inventory and assets, and that's become a big thing. As margins start to decrease and things like that, you can really get a look at the age of the fleet and how it's performing, and how you can sub out that fleet and do equipment upgrades and things like that. And for the resale market, we've got detailed hash reports around that, so that if you're going to start selling equipment and things like that, that you can utilize that. So miner management, really where it's evolved, has just become a little bit more robust, right? It's around, you don't think of miner management without thinking about the energy and the power controls aspect of it, the inventory and assets. So it's really, just a larger, more robust platform than, hey, we've got so many miners here and in what containers and what's online and what's hashing and what's not hashing. So it's become a little bit more complex product, and really just kind of the lifeblood of any, organization, and kind of how they're operating at a site level.
Rory, one for you that's targeted. You mentioned monetizing volatility earlier. We won't get to Michael Saylor on it, and I'd prefer if you didn't talk about the cyber hornets necessarily. But CleanSpark, like a lot of public miners, has a fat stack of Sats. What's your strategy? What's your kind of mindset when you go about thinking, how do I turn this into revenue for my company?
Yeah, I think if you really want to break it down, is it to its core philosophy. What we're doing on the monetizing volatility side is exactly what you're unlocking people to do on the energy side. And it sounds like what you have a background is, it's demand response for the market, right? What's interesting about where we sit is we have over 13,000 Bitcoin. We have over, 200,000 miners, over, 50 exahash operating. We have power plant and equipment. And, theoretically, we have a growth multiple on the business that, as the price of Bitcoin goes up, you're going to see kind of animal spirits come into the space. And so we sit in a really unique position, which is, we believe in Bitcoin. We didn't trip, fall, and land trying to put 50 exahash online because, obviously we're Bitcoiners, but we have these kind of three legs of the stool that benefit from increasing adoption and an increasing price. And so when you see that, what you also see is, you see a change um, in certain market structure characteristics of certain financial products. One thing I would say is the basis. So a lot of like hedge funds and financial institutions will put on a long Bitcoin position through the futures market. And the reason that you do that is because it's fast, right? You can go right in. Two, it's regulated and cleared, so it's lower risk. Secondly, is you can take is it's lower, it's capital efficient, because for every $100,000 of exposure that you take, you only need to put up $13,500 of capital. And so what that means in those futures or forwards, they trade on different dates. So let's say it's 30, 60, 90 days out. And so what you see is, particularly in a period of Bitcoin rising prices, the contract for 30 days out, 60 days out, 90 days out is trading above where the spot price of Bitcoin is. And as you see that kind of price continue to rise, the difference between the spot price of Bitcoin and that forward contract increases. So on an annualized basis, it's about 5% right now for kind of 30 to 60 days. You've seen it go as high as 12 or 15% in real kind of bull markets and less liquid markets. You can see it spike up even more than that. And so what we're in a position to do at CleanSpark is, we're mining 500 to 600 Bitcoin a month. We have 13,000 Bitcoin. We have all of these miners. We're in an excellent position to meet that demand with a response from our balance sheet, from our financial products, and kind of what we do. So that's the philosophy of it. Now, the actual technicals are, there's derivatives, you can sell covered calls, you can do the basis trade, you can put on different structures with derivatives. You can do some lending and borrowing, which we don't, we don't do too much of, and I don't want to overemphasize that because we're very risk averse, but there's a bunch of different ways that you can kind of take advantage of it. But really what it is how do you take the market structure of the financial products in Bitcoin, how they respond to these demand and price signals, and then where we sit as kind of a structural and natural offset to that because of our structural position as an owner and supplier of Bitcoin.
Gentlemen, final question, because we're running out on time here. We got about 4 minutes left. We've covered a lot of different bases so far, and just going back to that, kind of triangle of hedging, talked about Bitcoin, energy, and difficulty. Are there any products that don't currently exist that y'all are thinking that is what we need, that will take us to the next level for being able to hedge out some of these risks? Jeremy, we'll start with you and then finish with you, Rory.
Yeah, I think from the supplier side, I think the playbook is really simple, especially when you look down at ERCOT. Everyone's doing ERS and real time and just kind of flexing around it. But what I think is happening, obviously on the regulatory level, that's starting to be frowned upon, and it's starting to be watched more closely, because if you're being price responsive, then you're not meeting your obligations for your ERS commitments and things like that. And I think it's coming into play on the regulatory side. There's finite funds in these programs for some of them. Obviously, the ancillary market got depressed with batteries being deployed down in Texas, so that's really not kind of a big revenue driver as it was just a couple years ago. So with that in mind, it's really, trying to take advantage of what your supplier can offer and how you can utilize your energy load. I think, along the lines of derivatives and financial products, utilizing that energy and being able to flex it to liquidate power. Maybe it's taking more fixed positions on the miner side, being able to flex that liquidate power to, gain some financial advantages and some revenue there. But I think, just really, from a supplier side, leveraging all of your Bitcoin load against your CNI book. So maybe, a CNI customer is typically going to take a fixed price product because they need price certainty. They really can't take that volatility. They don't have a product that they can, manipulate up and down as quickly to price out to end use customers.
Commercial and industrial?
Yes,
Okay.
CNI. Yep. So with that in mind, utilize your flexible load within your book, leverage that flexibility towards your CNI, your more fixed price, and use it kind of as a hedging mechanism, and really use that flexibility. If you got a CNI customer that's maybe on, 7 cents power and things start to go down, you're going to ramp down the Bitcoin mining load even at a lower price, but there's going to be some mutual benefit to the end use customer there that's now going to go towards your more profitable customer on the CNI side. So I think from a product standpoint, really trying to increase some strategies from a retail electric provider side to take advantage of the flexibility as some of these demand response programs start to become a little bit more under the microscope.
And I think from my side, when I think more about directly the markets, I think that credit is generally has in the past been seen as a bad word in the Bitcoin space. I don't think credit is a bad word. I think mispriced credit is a bad word. And I think the promise of what Bitcoin is it's a, it's a forcing function to price credit correctly. And so what I'm really excited about is continuing to see structured products, credit products, insurance products, kind of all of this suite in this ecosystem that will continue to flourish, that allows you to break down and decompose the exposure you have to Bitcoin, the time you have to Bitcoin, the guardrails you have around it, because I think that there are just there's many different classes of investor, and there's many different mandates of capital that want to take a different kind of exposure to the Bitcoin markets. And I think that, we've seen through the strike lending product or lava or some of the other things that people are doing, people are kind of poking around the edges there. But I think that I'm confident that 2026 and 2027, we're going to see an absolute Cambrian explosion, I think, in sort of these more decomposed risks that allow people in different echelons to take exposure. Like, I don't want my grandma to necessarily, I mean, a lot of people like shout out American HODL. Like, he just put his mom in Bitcoin and like it worked out, but like, I don't know if I want grandma in like a full HODL position, but what I might want her is to get a performance linked note that's gonna take some that's gonna bring some fixed income while allowing the upside to Bitcoin, which is eating the credit and capital markets from dirty fiat.
Gentlemen, thank you very much.
Huge round of applause for these guys.